I remember the excitement when I first thought about creating a crypto trading bot. As a complete beginner in both programming and trading, the idea of a machine analyzing Bitcoin's wild price swings and trading for me around the clock was fascinating. I wanted something that could watch the markets 24/7 without fear or greed, making data-driven decisions even when I was asleep. StrategyQuant X looked like the answer. Its homepage promised a no-code approach, no programming required. StrategyQuant X turned out to be a powerful ally for a non-programmer like me. According to the website, StrategyQuant uses machine learning and genetic programming to automatically generate new automated systems for any market and timeframe. In practice, it literally writes trading rules by randomly combining indicators and entry-exit conditions. The documentation explains that the builder can mix millions of different building blocks, indicator conditions, price levels, order types, and so on to find the top strategies. StrategyQuant's site even advertises that it has a powerful backtesting engine under the hood to crunch through all these ideas. I like that description. A system of trading robots created by the software itself. StrategyQuant's website even showcases this with phrases like point and click, easy to understand interface. Indeed, its builder interface is organized into sections. A progress tab to start, stop runs and monitor statistics, a full settings tab for all the parameters, and a results databank panel where the generated strategies accumulate with their stats. The other big piece was understanding momentum. I had read that Bitcoin often moves in strong trends, so a momentum-based strategy could capture those swings. In simple terms, momentum trading means riding trends by rising, sell higher. For example, Investopedia defines momentum investing as buying assets that are going up and selling them when they look like they've peaked. A crypto guide made an apt analogy. Momentum trading in crypto is like surfing the waves you jump on when an asset gains strength and exit before the tide turns. In fact, analysts note that Bitcoin's price history shows this behavior. Gains have tended to follow gains, and losses have tended to follow losses, which is exactly what a momentum strategy tries to exploit. It made sense. Bitcoin's volatility means it often shoots up quickly, especially on hype or news. And momentum strategies aim to buy into that strength and get out before a reversal. With that big picture in mind, I dived into StrategyQuant X. I started with StrategyQuant's free 14-day trial so I could experiment without pressure. First, I collected historical Bitcoin price data, for example, daily closing prices from Coinbase. StrategyQuant allows importing this data directly. Then I opened the builder and started a new project. I chose Bitcoin, BTC, and set the timeframe to daily bars, at first, to keep it simple. I also picked a strategy style oriented to trends, momentum to guide the search. Importantly, I chose a genetic evolution mode so the software would improve its ideas over time. When I clicked start, StrategyQuant began its magic. I set the number of generations to 50, midway in the recommended range of 5,100, and let it run. It immediately started randomly constructing strategies by picking indicators and logical conditions. For example, it might create a rule like buy when RSI with period 14 is greater 60 and price greater 20-day moving average. The software does this by gluing together building blocks, technical indicators, price thresholds, logical and OR to form complete rule-based strategies. There truly are trillions of possible combinations, so it generates as many as it can and immediately backtests each one. I could watch the progress in real time. The progress tab showed generation counts and fitness metrics improving. After the initial random generation, the genetic algorithm kicked in. The best strategies were allowed to mate and mutate. StrategyQuant would take the top performers, combine parts of their rules, randomly tweak some parameters, mutations, and produce a new generation. This mimics natural selection. Each generation on average is better than the previous one, as it evolves more effective rules. Over dozens of generations, this iterative breeding produced progressively better candidates. The process continued until I stopped it or improvements slowed down. By using techniques like crossover and mutation, StrategyQuant's AI channeled human creativity at lightning speed. Meanwhile, I set some sensible filters in the builder settings. StrategyQuant lets you define criteria so that only strategies meeting basic requirements are kept. For instance, I told it to ignore any strategy that didn't make at least 20 trades in the period. I didn't trust a system that only had 2 or 3 lucky trades. I also set a maximum drawdown filter, for example, no more than 30% drawdown in the backtest, and a minimum profit factor threshold. These filters forced the software to discard obviously flawed ideas early. Essentially, it was churning through strategy ideas, and I kept only the candidates that passed these sanity checks. This let it focus the genetic search on viable approaches. When the run finished, I had a long list of candidate strategies ranked by their fitness measure, usually net profit by default. StrategyQuant provided key metrics for each one: net profit, profit factor, Sharpe ratio, maximum drawdown, number of trades, and more. I had to brush up on what these meant. I learned that Sharpe ratio measures risk-adjusted return, basically how much excess return you get per unit of volatility. The profit factor is simply total gross profit divided by total gross loss. So a profit factor above 1 means the strategy made money overall. 2.0 is quite good, 3.0 is excellent. Max drawdown is the biggest peak to trough drop, so keeping that number in check means less risk. I made it a point to balance these. For example, a strategy that doubled my money but had a Sharpe of only 0.5 for huge swings was less attractive than a steadier one with Sharpe 1.2 and a smaller drawdown. Some strategies in the list really illustrated the momentum ideas. For example, one top strategy bought Bitcoin when the 14-day RSI crossed above 50, and then sold or closed the position when RSI fell back below 50. That's a textbook momentum rule. It simply goes long when a momentum indicator suggests strength, and exits when the momentum eases. Another strategy was a moving average crossover. Buy when the 20-day exponential moving average goes above the 100-day EMA, and sell on the reverse cross. That's a classic trend-following signal, and seeing it appear in the results was reassuring. In total, I saw many variations of these simple rules. StrategyQuant rediscovered approaches that traders have used for years. I clicked into a few promising strategies to analyze them further. I looked at the equity curves and the list of trades. A good strategy had a relatively smooth, upward trending equity curve. For example, one RSI-based strategy had about 40 trades in the year, a profit factor of roughly 1.7, and a maximum drawdown around 25%. Its equity line steadily climbed except during one sideways period, which was pretty reasonable. Another strategy, the EMA crossover, traded a bit less often and had a profit factor near 2.0, but also a slightly higher drawdown around 30%. By comparing these charts and metrics, I started to see which patterns were reliable. At this point, the learning really kicked in. I realized that evaluating a strategy isn't trivial. Some appeared great on paper but had hidden issues. For example, one strategy in the list made a huge profit overall, but I noticed its Sharpe was low and it often waited to buy until Bitcoin was already near a peak. That strategy had a rule like buy when RSI period 14 is greater 70. Sure, it made money in bull runs, but it also suffered massive crashes. I learned to spot such pitfalls: buying too late or holding through deep drops. In fact, plotting the strategy's trades on the actual BTC price chart was very helpful. I saw entry and exit points visually, which made the logic crystal clear. Another concrete example. I found a strategy that only entered when Bitcoin broke above recent volatility bands, like a Bollinger BK channel. It would go long after a big move and set a conservative stop loss. In backtest, it caught the strong upward surges with fewer trades. This showed me that momentum doesn't have to be RSI or MA. You can also think in terms of breakouts. Each example strategy taught me something. Simple rules, one or two indicators, often were the best. When I allowed too many conditions, the results sometimes looked better in sample but rarely held up out of sample. I tried out of sample and walk-forward testing as well. StrategyQuant allows you to run the build on, say, 80% of the data and test on the remaining 20%. I set aside the last few months of data and treated it as unseen. After finding a strategy on the first 80%, I ran it on the remaining 20% to see if it still made money. In many cases it didn't, which was disappointing, but expected. It meant the strategy had overfit the ensample. If a strategy still worked reasonably on that holdout slice, I took more confidence in it. I even ran Monte Carlo simulations, randomizing trade order, as the software suggests, and watched how the results varied. These robustness checks, walk forward, Monte Carlo, parameter permutations, are built in and were invaluable in separating real signals from luck. I used StrategyQuant's advanced features to guard against overfitting. For example, I ran a walk-forward optimization. The tool automatically re-optimized the strategy on one part of the data and then tested it on the next, repeating this cycle. I also did Monte Carlo. The software randomizes trade fills to simulate many equity curves. Seeing that the core strategy concept held up under these tests, giving positive net profit in most scenarios, was reassuring. The documentation explicitly emphasizes these tests as ways to protect from overfitting. In plain language, it forced me to only trust strategies that had a demonstrable edge, not just a quirk of historical data. Throughout this journey, I picked up some practical tips. One lesson was to keep strategies relatively simple. StrategyQuant lets you set the maximum number of conditions per strategy. I generally limited mine to 3 or 4 conditions. I noticed that when I allowed 5-6 conditions, results sometimes looked artificially good but then collapsed in new data. Simpler rules like RSI above X or one moving average cross were more robust in my tests. Another tip was to be careful with lookback settings. I mostly limited indicator lookback to a few bars, so I wasn't relying on deeply historical data that might not be relevant. I also made sure to include realistic costs. There's an option in StrategyQuant to add commission or slippage. I tried adding, say, a 0.1% fee per trade, and reran the backtests. The net profits dropped a bit, especially for strategies that traded very frequently. It was a good reminder that more signals doesn't always mean more real profit, once fees are accounted for. In fact, one strategy that looked great without fees became marginal when I added commission. It told me to be cautious about over-optimizing for tiny gains. Another practical move. I saved my best strategies and projects. StrategyQuant lets you export the strategy code, for platforms like MT5, etc. But even before going live I would export the pseudocode and notes. I kept a log of what each strategy did, e.g. RSI 50 strategy held through 3 rallies, skipped 2 dips. This helped me compare which ideas were consistently finding the big moves. After many runs and tweaks, I ended up with a few strategies I was eager to paper trade. For example, one momentum strategy had a profit factor of approximately 2.1 and sharp approximately 1.2, with a max drawdown around 20%. It made about 35 trades in a year, nicely spaced to catch major upswings. Another was more aggressive, PF approximately 1.8, sharp approximately 0.9, drawdown approximately 40%. I decided I'd use less capital on that one. I also thought about diversification. StrategyQuant even advertises building a portfolio of non-correlated strategies. For now I kept them separate, but in principle you could combine multiple generated strategies, even across different cryptos or timeframes, to spread risk. The main idea was that when one strategy is flat or losing, another might still perform well. The whole experience was eye-opening. I learned more about trading metrics, strategy testing, and the importance of rigor than I ever would have just reading about them. StrategyQuant X handled the heavy math and coding, but I was still in control of the approach. For example, I often visualized trades on the chart and cross-checked if each rule made sense logically. StrategyQuant did the grunt work of trying a million combinations, but I applied the judgment, which rules felt reasonable, which looked like luck. This hands-on process grounded abstract concepts like Sharpe ratio in real examples. On the technical side, I was impressed how user-friendly it was. I started a build and let it run while I did other things. StrategyQuant's superhuman backtesting engine really is fast on my computer. Generating and testing thousands of strategies took a few hours. I often let it run overnight. I could pause or resume the build anytime, and even adjust settings on the fly. I monitored logs to see how quickly the progress charts improved. I spent a fair bit of time just staring at numbers, trying to internalize what they mean. For instance, I often compared profit factor versus Sharp. A profit factor above 1.5 was usually a good sign, but I also cared that Sharp was above 1.0. A low Sharp strategy, say 0.5, with high total return felt like it was achieved with too much volatility. On the other hand, a modest 30% return with Sharp 1.5 and only 10% drawdown looked appealing. Through trial and error I got a gut feel for what metric ranges felt healthy for a momentum approach. One strategy taught me an important lesson about timing. It had a rule like buy when RSI with period 14 is greater than 70, which seemed aggressive. In backtest it made big gains on bull moves, but it was literally buying at overbought extremes. When I plotted its trades, I saw it often entered right at the market peak, then took a big hit on the reversal. This reminded me that momentum strategies need a good exit or stop. I went back and added an exit rule for that strategy. In general, having both entry and exit conditions, like a second indicator crossing down, improved stability. I also experimented with training validation splits. StrategyQuant lets you train on one portion of data and test on another. I tried withholding the last several months as a validation set. After finding a strategy on the first portion, I checked its results on the holdout. Most strategies lost steam out of sample, which reinforced that I must trust only those that survive new data. Each time a strategy passed both in sample and out of sample tests, I felt more confident it had genuine edge. By this point, I had learned to juggle many considerations: entry rules, exit rules, stops, and performance metrics. I even looked at the pseudocode output for a strategy. StrategyQuant can export the full code, just to understand it. I didn't need to code it myself, but reading the human-readable version helped. For example, seeing a condition written out in words clarified what gains have tended to follow gains really meant in the context of that strategy's behavior. In the end, I was grateful for this learning journey. Building a bot like this with StrategyQuant X has been a rewarding experience. I started with no coding or trading background and ended up with actual strategies I understood and could trust. I felt like I did trade like a quant without writing a line of code. Not every strategy will work in the real world, but each iteration taught me something new about the market. For anyone curious, StrategyQuant's website even offers a free 14-day trial with no programming required, so it's easy to start experimenting. It's an iterative process, not an overnight miracle. I encourage other beginners to try it out. Generate some strategies, see how they perform, and learn from the ones that fail as well as the ones that succeed. The most important takeaway is to understand why a strategy behaves the way it does, rather than just trusting its results blindly. I am excited to keep refining my strategies and possibly testing them in a demo account. Maybe next I'll try adding other coins or different timeframes. The crypto market will keep changing, so any bot needs constant attention. But the core skills I gained understanding momentum, setting up a systematic search, and interpreting backtests will serve me in any market. A final note: the StrategyQuant documentation and community forum were full of helpful tips and examples, making this feel like a friendly learning community. Experimenting has been fun and illuminating, and I am looking forward to seeing where it takes me next, one step at a time. Thank you for watching.